Hello, everyone. My name is James Salvato. I'm with Salvato Tax and Accounting. Today, I'm going to be presenting to you tax liens and levies and what to do with them. Um, I am an enrolled agent. I am not a CPA. I cannot call myself a CPA because of the fact that I cannot certify financial statements like a CPA could. I'm also not a tax attorney because of the fact that I could not represent someone in tax court. However, considering the fact that most of the cases that I help my clients with do not go to tax court, I am still pretty valuable as far as assisting you with your tax situations. Anyway, as I said before, this is what I'm going to be talking about today. A lot of people come to me and they say, what's the difference between a tax lien and a tax levy? Well, a tax lien is pretty much a notice that you would get saying, hey, if you don't pay us, we are going to levy your property and we're going to seize your bank account. We are going to take the cash value of your life insurance policy. We're going to liquidate your retirement account, and we could even foreclose on your house. Um, it's pretty much a warning shot across the bow before they do something like this. It's public knowledge, and the reason why it's public knowledge is so that your creditors know that they are first in line before those creditors in order to get paid when it's time to do get paid. A levy, of course, as I mentioned before, is pretty much you already ignored the lien. And so now the IRS or the Illinois Department of Revenue or whatever tax agency is out there are saying, look, we gave you all these opportunities to pay us and you ignored us. So here we are. We're going to come over and we are going to take your property. Your bank accounts are going to be frozen. You can't retire anymore. You don't have any cash value in your life insurance policy anymore. You're screwed. However, in a lot of these cases, it's not all is not lost, and I'll tell you why. So before we get about what to do in those specific cases, it's important to know what exactly is the collection process to begin with in order to get to those levies and liens. Um, so first and foremost, you file a tax return and you owe money. After you file the return, you're going to get a CP-14 notice saying, hey, guess what? You kind of owe us money. Pay this amount when you get a chance by it within 30 days. And so it's not very threatening. It's just saying, hey, we know that you filed a return, we processed it, just pay up what you owe. When that doesn't happen, you would get something along the lines of a CP 501 notice. That's just another reminder saying, hey, guess what? You might have a balance due. Let's see, maybe you didn't get the first letter or something like that. So just want to remind you that we do have a amount due out here. And if something doesn't happen, if something doesn't escalate, it could possibly get worse. Then we got a CP 503 notices. And then usually in these cases, they'll say, hey, we haven't really heard from you. Is there something wrong? We really want you to pay this amount. And in a lot of cases, I should say, sometimes the client didn't receive the first two notices. And so they open this up and say, hey, maybe we should pay this and pay it off. But in other times it goes directly in the garbage. And that's when we get to the CP 504 notice. And that's when you get the notice from the IRS saying, hey, it's time to pay up. Yeah, you have to pay us. Um, we are going to take we're going to do certain actions in order to make sure you do pay. A lot of people wonder though, what exactly is when it comes to stuff like this, I should say. I'm sorry. When it comes to these kind of things, there's usually a multi-step process to get out of this situation. So, for instance, a client will come to me and say, "Hey, I haven't paid I haven't paid any taxes in decades. I haven't filed anything. I didn't pay anything. I don't know what I would owe or what's going on." So I usually, in a process like this, I usually get them compliant with all their tax obligations first. I make sure that all the tax returns are filed. For the IRS, the statute of limitations is pretty much 6 years. So they want the last 6 years to be filed. And anything before that, they don't care. Unless, of course, there's an active there's an active collection effort on something like that, then it doesn't. We don't really have to concern ourselves too much. If there's an amount owed for the current year, they want estimated tax payments paid up to that point in time. So if someone owes $15,000 as of their 2019 tax return, they want to make sure that their all estimated taxes for first, second, and third quarter have already been paid. And the most important thing that's the hardest part for any taxpayer is they have to be in good standing for the next 5 years. That means they can't owe anything for the next 5 years. They have to make sure that everything is filed within the next 5 years, or else the IRS starts, they start questioning things again, I should say. The next aspect of something like this is tax resolution. So, yeah, you owe the amount due. However, there might be the IRS isn't going to say, look, you need to pay $15,000 all up front. We're going to take your house. That's not how it's going to work. They're going to say, hey, you have about maybe $1,000 in penalties, but hey, you were such a good person. You haven't filed any, you haven't requested a first time abatement or something like that. So let's maybe abate, we'll knock off $1,000 as far as penalties are concerned. Or maybe we can put you on an installment agreement. You don't have to pay it all at once. Maybe you can pay over a few years. Or maybe you're in such dire straits right now that the IRS will say, look, your situation is so bad, maybe it might be a good idea that we just hold off from any collection activity for the time being. And then we have an offer in compromise in a sense where they say, well, maybe there's no chance that we can actually collect the amount that you owe us, but we'll accept this amount instead. And then last but not least is typically in some cases you can use bankruptcy. When it comes to penalty abatement, as I mentioned before, I mean, you can do first time penalty abatement. And that's like I said, you have to be compliant within the past 5 years. You didn't file for any penalty abatement within that period of time. You could also have reasonable cause. Let's say that your house burned down or you were in such mental distraught because your son died for that year. You could have the penalties removed in that kind of case. I mean, it's a possibility, but it's not a guarantee. Or, for instance, if you also received incorrect advice from an IRS professional, that also can help you with penalty abatement. So, if the IRS agent told you, don't worry about filing something, and then that advice made them incur additional penalties and fees, well, that penalty can be abated in a sense. And last but not least, in this case, would probably be bankruptcy. Bankruptcy generally is not you're not able to discharge tax debt in bankruptcy. However, punitive penalties and interest, like penalties, these penalties in a sense, um, they are dischargeable in bankruptcy. Installment agreements is pretty much where everyone typically ends up when it comes to negotiating with the IRS if they can't pay up front. There's about four different types of installment agreements. There's a automatic installment agreement, streamlined, a regular one, and a partial pay. The automatic installment agreement, that's the most common one that I've seen so far. A lot of people who put on these are typically owed $10,000 or less. You got to pay it off within about 3 years. And you really don't have to disclose any financial information. The IRS will not want um, they will not want your financials. They don't care about how much money is in your bank account. They are not going to care how much is in your retirement account, for instance, or if you are able to, um, what's the right word? If they're able to get more out of you. I mean, as long as you state, hey, I can pay $350 a month and I can pay this all within a certain period of time, they're like, hey, all right, good. I'm happy, you're happy, we're okay here. The next is a streamline installment agreement. Um, this is typically a little bit more complicated than an automatic installment agreement. When you see companies out there, tax resolution companies that talk about fresh start program, this is typically what they're talking about. it's a little disingenuous in what they're saying, but the concept is true. If you owe $50,000 or less and you don't have any back taxes in the last 5 years, you can, as long as you fully pay the amount within 6 years, you're pretty much good to go. You don't really need to disclose a lot of financial information. You probably need to disclose how much you have in a bank account. You probably need to be put on an automatic payment plan of some sort, where they directly debit from your account. But other than that, it's a very easy process to go through. This is the regular installment agreement. Typically, if you're over $50,000 and you have the ability to pay for it over 6 years, this is most likely where you're going to go. It has to be approved by the IRS. You submit the paperwork and everything. The IRS does have to approve it. They have to say, okay, I get it. This is all the information I have, financial information, bank account, checking account, investment account. With that knowledge, I believe that this should be okay, as per the IRS. So it's more involved, and so of course it's a little more complicated, but it does happen. If you have the ability to pay for it and you owe $50,000 or more, this is where you would need to go. And the last one would be partial pay installment agreement. This also it's just like a small concept outside the regular installment agreement. Let's use that example again, and where you cannot necessarily make the payments within 6 years, but you can still make something, and you wouldn't qualify ordinarily for the an offer in compromise. So you'd go for something like this in a sense, where you pay a certain amount up to, let's say a year, 18 months or something like that. And after that period of time, the IRS will come back and say, hey, you've been making this payment over about the next 18 months. How is your financial situation coming along? I think it's time to renegotiate that amount. And if you still owe an amount at the end of that term, you still have to pay that amount. There's a balloon payment at the end. Last but not least, we have the offer in compromise. This is the big daddy that everyone generally talks about on the internet, on the TV commercials and whatnot. They say, "Hey, we can settle this amount for pennies on the dollar." That's also extremely disingenuous. When it comes to figuring out what the IRS will be willing to accept, it's not a matter of just throwing something at them and hoping that they take it. It's a little bit more complicated than that. The IRS has standards and regulations that they follow, based on where you live, how much money you make, what your assets are, and what your ability to pay is over the next 3 years. And based on that scenario, will determine what there's a calculation they'll say what this you as an individual could pay over that time. It could take as much as 6 months to a year to get approved. I'm going to tell you that much. It is not something that can be decided over in a matter of a couple of years, or I'm sorry, not in a couple of days. I'm sorry. This is something that you do have to. It's long, it's tedious, and you do have to now go through to everything. There are two different types of offers in compromise, though. There's one where, in a sense, you filed the offer in compromise, and as long as you can make the payments over 5 months, you just put a 20% of that amount down, and you make the other five over that period of time. Or you could do an extended period, which would be between 6 months to 2 years, and just the first month will be due. And if you can make that amount, that's fine too. So, what are some of the common issues with offers? Um, One of the biggest ones that I notice is with clients is, are you currently compliant? Some people will try to file an offer in compromise and they haven't filed any returns. Well, that's not going to really help their case that much, is it? Or how about they file an offer in compromise and, oh, guess what? Next year they owe another $20,000. Well, that's not really a good case for them, is it? The second point is, can you pay the liability in full? Sure. If you owe $50,000, for instance, you want an offer in compromise, but you have $360,000 in the bank. There's a good chance you could probably pay that $50,000 in full. The IRS isn't going to accept it. The next one is there any dissipated asset issues? I'm going to talk about that in another slide, but it's important to know. And are there any non-cash expenses? Non-cash expenses would, this is typically important with a lot of businesses, for instance. And in these cases, you're going to see depreciation, for instance, or you're going to see amortization, or even, what was the other one I saw? I can't think of it at the moment, but those are the big two. Depreciation and amortization are the big two that come to mind with these things. Normally, in cases like these, you buy a product but you buy an asset, and over that asset, let's say if it's a car, you don't expense the car all right away in business. You have to depreciate it over a period of time, typically 5 years. However, that depreciation has to be added back and trying to figure out what your offer and compromise would be. And the last one is if there's any orders of restitution. I'm going to get this detail a little bit more too as well, but this has mostly to do with the Department of Justice. So as I was saying before, dissipated assets is an asset that was sold or transferred by the taxpayer, which should have or could have been used to pay the IRS. So I have a few clients, I gotta admit, they owe money to the state or the IRS, and they decided to pay other vendors instead, like say the landlord or the utility company. Well, if the IRS or the state found that out, they're not going to be too happy. They're going to consider this as a dissipated asset, and they can come back and say, hey, we think you're being willfully negligent here. We think that maybe instead of making this a civil matter, we need to make this a criminal matter. And so then things get a little messy. This isn't typically the case, and a lot of times, sometimes, they'll say, "Oh, well, maybe you screwed up. Maybe you really needed to make this payment. We'll let it slide." But and let's say like Wesley Snipes' case or something like that, they want to, let's say Wesley Snipes, for instance, deliberately made payments to other people instead of who he needed to pay with the IRS. Well, that could send you to jail. Bankruptcy. Yes, the one concept that I didn't really go into detail a lot. With bankruptcy, the automatic stay applies to tax debt. When you declare bankruptcy, you get 6 months, where a cooling off period where all the creditors are notified and they're saying, hey, look, this person's going through bankruptcy. Hold off on any collection activities for the time being. That includes the IRS and any other tax agency. However, bankruptcy is tax debt is generally not dischargeable in bankruptcy. There is a process for it to happen. However, that process is very tedious and not likely to help you out very much. It's best to assume that if you declare bankruptcy, your tax debt will probably need to be negotiated after your bankruptcy clears, because it most likely will not be discharged. Some of the things that will be discharged, of course, as I mentioned before, would be penalties and interest that are punitive in nature. So, of course, failure to pay, failure to file, failure to, have have a tax set lower than $1,000. Those are more punitive in nature. This one, other tax, other penalties, like say, for instance, the failure to file your trust fund account. No, that's not being discharged. Sorry. There's no possible way you can actually discharge that. So I'm not an attorney. I don't file bankruptcies for a living. So if you have a tax debt, your best bet would be to consult a bankruptcy attorney and then talk to me and let me know what they say. This is the other point that I was wanted to make a note of. When you have an orders of restitution, this is where the Department of Justice says, "Hey, you did this. You had this criminal or civil matter," and the Department of Justice says, "You need to pay the government a certain amount of money. Let's say $60,000 because you spray painted a Nazi signal, swastika on federal property or something like that." So that would be an order of restitution. You'd have to pay that $60,000. That can't really be negotiated. You have to make that payment. Um, However, when you're doing an offer in compromise, that order of restitution is included in what you can pay as far as an offer is concerned. Payroll returns. Believe it or not, most of the tax resolution cases that I come across are due to payroll returns. These, whatever you want to believe, they cannot be discharged in bankruptcy. No ifs, ands, or buts. They are trust fund accounts, and not only are they trust fund accounts, they they transfer to the individual, the responsible individual that's in charge of this. That could be either the owner of the company, that could be the bookkeeper, that could be the person who has signing authority on the bank account. These things are really important to know and really important to consider when doing payroll returns. If you are not directly responsible for payroll, it is highly advised that you separate your duties as far as payroll is concerned as much as possible. Um, if, for example, you decide not to file payroll returns, and the IRS or whatever your state tax or local tax agency declares you willfully negligent, then it will also go towards I'm sorry, you could also potentially suffer criminal consequences in this regard. I'm not an attorney. I don't know what criminal consequences would constitute, whether it be 24 years in jail or something. I don't know. That all I know is that it could be bad. That's all. Anyway, I hope you enjoyed my presentation today. I know it's not a lot. I know it's kind of quick, but these things are not really a laughing matter. Over the next year or so, the IRS and your local tax agencies are going to be ramping up their collection efforts. A lot of people still owe a lot of money, and a lot of people still haven't filed taxes. My business has grown exponentially because people needed to file their taxes, and they had back taxes they needed to file too as well. Typically, when you haven't filed in years, you might actually owe money. And so in that case, it's a good idea to just get it done and over with. Um, at least when you have the returns filed, you don't have to worry about staying compliant. Yeah, that's half the battle. But anyway, feel free to contact me if you have any questions or concerns. Um, I don't really do a lot of presentations. I'm trying to get used to figuring out different ideas that we can do as far as like this is concerned. Um, Give me a call or shoot me an email if you have any questions. Okay. Thank you very much.